Hey guys, Akil Stokes here. Welcome back to the weekend edition of The Trading Edge. Hope you guys are enjoying your Easter weekend. And because we're in a celebratory mood, I wanted to give you guys a special present for this week's video. And that's going to be a free massive training lesson on how to trade using technical analysis. Now, this lesson came from day 2 of our Emergence trading event that's going on. And I'll tell you what, if you haven't done so already, make sure you sign up. The event goes until the 22nd. It is still free. There are 30 plus hours, or at least gonna be 30 plus hours by the time it's all said and done, of free trading content that will push you along the path of becoming a consistently profitable trader. So if you haven't done so already, I don't know how you can tell yourself that you're serious about becoming a good trader, because you're gonna get more value for free here than what you're gonna get paying for different courses out there. But hey, everyone's different. So I hope you guys enjoyed the video. I hope you guys have a great Easter weekend. And again, if you haven't registered already, there is still time. www.tier1trading.com. Sign up for Emergence, get the login information, watch the recorded sessions, join us for the live sessions, and network with a great community of traders of all levels. All right, see you there. Don't necessarily know about this process yet. You're going to learn about it tomorrow. So you get kind of a sneak peek at tomorrow's lesson. But we're going to talk about a 4-step process that we use to analyze the market. And it goes like this: identify, predict, decide, execute. We call it IPDE. And it is a crucial process into us staying consistent in our analysis. If you followed us for any given time, you know that our motto is simple: consistent analysis plus consistent execution equals consistent results. Meaning that if you analyze the markets the same way and you take the same type of trades, the ones that you're supposed to take, and you actually take them and don't self-sabotage, which is easier said than done, then you should expect to execute your edge if your system has an edge, and that means you should be making profit. So we want to be robotic, we want to be systematic, we want to be mechanical in how we approach the market. Again, just like any type of business. If you look at any type of business out there, if you ever are a franchise owner, when you own a franchise, right, you get very strict directions on how that franchise needs to be operated, because there is a proven system on what you need to do to make money, and your job is just to follow it. It's not to kind of do something out of the box. So the first thing we want to do when we look at a price chart, and this process works the same, no matter what time frame you're on, you're going to see me we'll probably go from daily all the way to the 5-minute. I do both day trading and swing trading analysis here, although they are separate. You'll see me venture to both. But it doesn't matter if you're a swing trader using the weekly and the daily. Doesn't matter if you're a day trader using please don't use the 1-minute chart, but the 5-minute chart, something like that. The process is going to be the same. So I don't want you guys getting caught up on like, well, does this work on the 30-minute? Does this work on this, right? We always get those questions. The answer is yes, right? Markets move the same on any time frame. There are little tendencies that are different, but the same movement exists. Range bars as well, if we go there. I'm going to try and avoid range bars. I don't want to confuse people too much, but range bars as well. But the first thing we want to do is the I process, which is, identify. We just want to identify where is price at, what are we doing? And hopefully you guys downloaded these already, but these red and green boxes on your screen, these are our VS1 levels. So our visual structure indicators. And the cool thing about this is it gives you an extra eye on the market. So typically you don't start your market, your analysis zoomed out like that. You're probably like this. And if we didn't have these bad boys on here, you're looking at this and it kind of looks like price is in the middle of nowhere. Would you guys agree? We've just broken a crucial level of structure to the upside. This is a bullish trend continuation opportunity. Trade it to the moon, right? Because you don't have that perspective. Now, again, if you zoom out, that's one thing. Or if you forget, because we do get a little bit lazy as traders sometimes. It's natural, we're humans. We shouldn't do it, but it happens. You have these things on here. It's a big red warning sign that says, wait a minute. We are not in the middle of nowhere, are we? Because there's a big red box. And we know that that big red box means that there's a previous level of structure. And you can see that we have not violated that previous level of structure. So I should probably zoom out and see where we're at. So We identify where we're at, and we can say that we are at a previous structure high. Would you agree? For you guys that watched the Trading Edge video this week, we're also at one of those ICE zones, or structure swaps as I call them, because I wasn't cool enough to invent the word ICE zone. I'm bad with names. Horrible. I'm glad I didn't find the cipher there, and I would have named it something dumb like the fuzzy bear, and it's been made fun of for all of eternity. I'm really bad with names. If I'm bad. Yep. Does anyone not know what I mean when I say ICE zone or structure swap? Let me know and I can explain it. Again, I want to slow things down and make this educational. I'm not too worried about just hunting trades. But if you don't know what that means, let me know and I'll give you a kind of a brief tutorial. It means it follows up on our lesson about structure the other day. I take it you didn't name your kids. No. They would have had weird names like Gartley. Gartley and Bat. Gartley Stokes and Bat Stokes. It wasn't flying with the wife. All right, so ICE zone equals structure swap. Yeah, so ICE zone and no D, just ICE, ICE, and structure swap are the same thing. It's just different words. So it's, what you'll notice in trading, and this is probably for worst actually. The one thing I hate, I hate scammy people that give you unrealistic expectations. But another thing I hate is, from an educational standpoint, is the fact that there's no general definition there are no general terms, or very limited general terms in the market. I don't know how many of you guys have experienced that. And what I mean by that is that we have terms double top, we have terms pin bar, we have terms triangles, wedges, but they're not always the same. So if you're bouncing around between different educators, different books, different videos, you may hear the same term, but it may actually look like two different things. And that is it's hard for newer traders because now you're getting confused. So I called it structure swap because I'm uncreative. What I later learned is that a trader that I look up to, Peter Brandt, actually looks at the same level but calls it the ICE zone, and it makes a lot more sense. So an ICE zone is a level of structure that has gone from one to the other, right? So we know that a trend looks like this, right? What type of trend is this, guys? Bullish or bearish? By the way, I forgot that real quick. Our little news briefing, I got right into the intro. News briefing, got a few things coming out today. I get sidetracked very easily, so just deal with it. We got CPI coming out 8:30. This is more important than it seems. FOMC member Brainard speaking at 12:10. She may be the next Fed chair. And then later tonight, for you guys that are going to be up during the Asia session, we got a interest rate statement and decision for New Zealand later on tonight in a very low liquidity time in the market. So this can be very dangerous. I don't advise being anywhere near the markets when that happens. 12:10 is probably a little bit more dangerous than it seems. Just dealing with our inflation deal, especially after the CPI numbers come out. So 8:30, 12:10, 10 p.m. for our news briefing today. How important is news? And sorry, and I'll go back to the actual question. Tim says, how important is news? Not really important as far as a trading perspective. Now, we're technical traders here. We have a technical bias. So everything that we do is based off charts and chart patterns and price patterns and stuff like that. I do think it's important to be aware of news for two reasons. So good traders are great risk managers. If you can avoid a situation where the market is acting irrational, that is a risk management tactic, right? If you can avoid a situation where the markets are going to be emotional, they're going to be irrational, because a lot of these news events, what happens is it's a very short-term emotional reaction where everyone's like, oh my gosh, right? They fear, greed, all that fun stuff. And then you look back at your chart a few hours later and everything went back to normal once they actually analyzed the news. It's like, okay, well, nothing big happened. And there's a whole under level of that about insiders and smart money and fun stuff like that, but then manipulating us as human beings, which we'll leave for a later workshop. But if you can avoid situations where your edge doesn't really have an edge, that is a way to manage risk. Now, on the other hand, you'll hear us mention something from time to time called home run trade. So if you are someone that is familiar with the news, and if you are someone that can do a good job of predicting the news, or at least what you think the prediction will be, if you have a technical setup, and this is important because the technical setup has to be first, in my opinion. If you have a technical setup in the same direction as a predicted fundamental setup, that offers the opportunity to hit what we call a home run trade, which is a bigger than normal trade. Because again, your technical setup is first and foremost. The chart is telling you bullish. Let's say you're predicting a bullish reaction from whatever that news event is. It gives you a chance to shoot for an extended target and make a little bit more bang for your buck out of that move. So news is not too important, but as you grow as a trader, it can be useful to be aware of what's happening. I would say especially as a day trader as well, as news is going to have a bigger effect on the lower time frames than the higher time frames because there's less time for that correction. Very good question. And news is one of those things you learn over time. You know, I recommend just when news events come out, you just keep track of it, look at the reaction, look at what was said, keep little notes. The importance of news changes over time. So what's important now may not be important next year. So it's just like trading. It's a skill that you learn over time. And you know, I can tell you this, the more you learn about crowd psychology and human beings, the better you'll understand why news is moving and what's likely to happen. Very good question. So this is a bullish trend. You guys are right. So to continue our trend, we do this, right? This is a retracement, right? Now this swing point up here, right? The point where we went from our new structure high. And again, if you watched the videos yesterday, you should be familiar with this. The point where we went from our new structure high and retrace, this ends up creating what's called a level of structure or a level of resistance. Does that make sense, guys? Each time we have these pivot points, these swing points, these become levels of structure. These are key levels in the market, right? We can simplify things by calling everything up top resistance, everything at the bottom support. And give me a yes if that makes sense. Again, don't be shy. If it doesn't, just let me know. This is not I don't know where you've been to before, but this community isn't one where we're like gonna make fun of you and laugh at you if you ask a quote unquote dumb question. We're gonna help you out. Now, if you ask something like, Akil, should I buy this trade and not place a stop loss? Then we'll make fun of you. We'll point and laugh and shame you until you leave. But you deserve that if you do that. You should probably place a stop loss. But yes, that makes sense. So when price needs to continue, if price is going to continue this trend, right? The first thing that's going to happen is we're going to retest this level of structure. And this is going to end up being a decision point. And we call it a decision point because one of two things can happen, right? This is when we use that if-then syntax, where if price holds, so refuses to break this level, that's a good sign for a potential counter trend opportunity. So that the trend may be over and we may be seeing a move back down, back into consolidation, or maybe starting a bearish trend. If we break that level, violate that level, then it's a sign that the trend has continued, right? So if we violate this level, again, extension, right? Longer than our pullback, continuing our pattern of higher highs. Would you guys say that this is a confirmed bullish trend? Told you I was going to test you. Thought I was playing. Tim says no. Why not? Tim says no. Why not? I played a little game with myself this morning. I had about 1, 2, 3, 4, 5, 6, 7, 8 trades on the radar. I said, with the way I rant and get off subject, we're probably going to get into some training stuff here. I said, I wouldn't be surprised if I look at 4 of them. That's my over-under. I bet against myself on the under. Needs another structure for retest. No, this is a confirmed trend. So remember, our training yesterday, who can tell me, what do we need for a confirmed trend? We need a 3-point move, right? We need our initial structure high right here. We need our pullback right there. And then we need our new structure high. So this is our confirmed trend right here, right? as long as we continue to make those higher highs, we are still in that bullish trend. So we don't need another structure retest. When we have that 3-point move, that confirms our bullish trend. Now, after this extension, right, this thing doesn't last forever, right? At some point it will come down. What do we expect to happen after this extension? So remember, 3-point move, Tim. Initial structure high, outside return, retracement, pullback, whatever you want to call it, and then new structure high. And then as long as we don't violate our previous outside return, so as long as we don't violate, which would be this level now, we're still in that confirmed bullish move. We would get a pullback. Now, if you had to make a prediction on where that pullback is likely to come to, where would you say? I didn't mention this in the intro, but I'm going to put you guys to work. I'm not the type of coach where it's like, I'm just going to show you everything. No, I'm going to ask you questions and put you to work. And I know it may be a little funny, but it is the best way to learn, right? And even if you're wrong, like I said, I love that Tim said no, and then we got a chance to explain it. Because if Tim didn't know, but felt the pressure and was like, yeah, he never would have had his question answered, and he never would have progressed. So never feel embarrassed or shy about asking a question, even if the rest of the chart or the chat is saying something, right? This is how you learn. If you don't ask the questions, you don't get the answers, right? Yeah, so we would expect a pullback to previous structure. So again, what once was a level of resistance now acts as, or we would expect it to act as support. This is that structure swap or that ice zone. And the good example that Peter Brandt gives is imagine those structure levels being like a frozen lake, right? The fish below the lake, right? That level or that slate of ice stops them from breaking through to the upside. At the same time, the human being or the animal walking on the lake, that piece of ice stops them from falling in. So basically it's resistance turning into support, which is a really clever example, which is why I'm so embarrassed about structure swap. So we're at a similar, well, let me pause. Any questions about that before we get back into the analysis? We don't need fib levels for retracements, although those can be great tools in predicting where those retracements will come to. Yep. But not necessarily for the pullback, but those are great tools for predicting. If you're into the fib stuff, not everyone is. Tim says, what if it breaks the previous structure? Is it still bullish? Yes. So our trend is violated once we violate our previous outside return. So at this point, this little circle right here is our previous outside return, right? In a perfect world, price would come right back to our previous level of structure, hold and extend forever. It would make our trading life so much easier if it happened like that every single time. Oh man. The millions we would make if it happened like that every time. But like I mentioned before, right? The market doesn't follow a textbook. The market doesn't take our training courses and be like, okay, well, I'm going to do this because Jason and Nikhil said so, right? The market does whatever it wants, whenever it wants. So it can retrace down here. It can retrace deeper, right? It can retrace down here. Now, let me ask you this. If price retraces right here, what's our trend? Bullish, bearish, or consolidation? Evan says bullish. Yeah, the questions are getting tricky. Ooh, Apple down to start the day. Is time symmetry important? No. It's harmonically nice when it happens, but not necessarily important. It's not bad when it exists. When you can get equal slopes and equal measured moves between pullbacks and extensions, and it means the market's moving pretty harmonically. It can help with some really good predictions, but it's not necessary. It's a good question, right? So we are still bullish, right? Why? Again, what would take us out of our bullish trend? A violation of this level. When I say violation, we didn't teach this yet, but we mean a lower low and lower close. So price has to close below that level. So although we are here, we have not violated this level. So we are still bullish, right? We can actually do all types of funky stuff in here. Until we violate this level, we have not violated our bullish trend. Now, if price breaks and closes below this level, now what do we have? Are we still bullish? Or has the bullish trend been violated? Yep, the bullish trend has been violated. So we were saying, hey, we're bullish. Not anymore. So this is when that bull trend ends. When the outside return has been violated. So a very simple way to do this, and this is how we teach it in Foundation, right? Zoom in here. We will get back to this example eventually. I'm going to be way under on my over-under. So if we have our trend like this, 3-point move. I like to do this. I'm really big on the visuals. Again, that's why you see the VS1s on my chart all the time, because I like the visuals. These like little slaps in the back of the head that remind me of stuff. Hey, dummy, structure. Oh, okay. Right? These are the levels that matter. The outside return and the new structure high, right? And we haven't talked about fractals too much. I talked a little bit about the snowflake example in the training. But the hardest part about trading and reading price, and again, most people won't tell you this, is the fact that within these moves, these trends or these extensions and these pullbacks, there's going to be a million little moves that are all there to confuse you. And that's the market's job, right? The market wants to act like a magician, where it shows you dancing girls and flashing lights and all this funny stuff to distract you. And then boom, the trick happens and you don't even know it. Our job as professional traders is to ignore the junk and just focus on the sleight of hand. All right, so I like to bracket off these two levels and make it simple like this. If we violate this level, the trend is violated. If we violate this level, the trend is continuing. And then everything that happens in here doesn't matter as much. There are trading opportunities here, don't get me wrong, but it doesn't matter as far as us saying trend is violated, trend is not violated. We can do all types of dancing here. The fact of the matter is, if we violate this level, we're in continuation. This is nothing but a complex pullback, multiple leg retracement. If we violate this level, trend is violated. Does that make sense? I recommend just doing this, finding your swing points, drawing a line. You can write words on there, do whatever you want. Previous outside return, that's our key violation level. Previous new structure high, that's our key violation level. We got to learn to ignore, as far as reading a trend, ignore the stuff that's happening in the middle, because it's just there to distract us. Again, there could be plenty of trading opportunities in here. But as far as analyzing a trend, Jacques says, do you not wait for confirmation for break? It might be a spike. Well, that's why I didn't say break. Notice the terminology I've been using. Did I say break or did I say violate? We need a violation. Higher high, higher close, or lower low, lower close. Yep, break and close. Emphasis on close. I may have actually said break. I don't know what I say half the time, but I know I said violate. So does that make sense, Jacques? Break and close. The close above. A spike above would not be a violation. So when we say violation, I got to remember we haven't talked about a lot of this terminology with you guys. So that's a good question. When we say violation, we refer to a violation as a break and a close beyond the level of structure. The close is important because a break doesn't tell us a violation. It tells us a different story, right? We know how to read candlesticks, right? A long wick to the upside tells us a different story, but we need a violation. So all of this lesson was just to tell you that we're at an important level, guys, right? Going back to the chart, structure swap. Do you see it? That was the long-winded version of telling you that we're currently at a structure swap level. We're at a current level of structure swap, right? So this is an important level of the market. This is a decision point in the market. This is also the Brexit highs. This is what we identify, and then we want to start predicting what could potentially happen if the market moves a certain way. We can make a prediction lower. We can also make a prediction higher. For today's purposes, I'm going to make a prediction higher because that has a lot more opportunity, in my opinion, than the prediction lower. Now, real quick, Jacques said, why would 2016 structure have any impact or relevance 6 years later? Because it is the most recent level of structure. That's why. So the most recent level of structure is always going to be the most important level of structure. So going back to what we spoke about in the beginning, right? Our most recent level of structure that has not been violated or that has been violated is right here, right? So here's the question I would ask, right? So we took out this level of structure. So what's next? Aside, if we don't use the most recent level of structure that hasn't been violated, what's next? How else can we make a prediction on where price action is at and what price action is likely to do? What else can we use, guys? Well, remember, if we're not allowed to use the 2006 level of structure, what else can we use if we're taking that out of the equation? Could use fibs, yeah. Here's a question, and this goes off of really your trading philosophy. So you're gonna find very quickly that structure is the backbone of my trading philosophy. So structure is by far the most important thing in the market for me. There's nothing more important than structure. It tells us the biggest story. It is, not to get too much into supply and demand, but it tells us the relevant levels of price, of past price decisions, right? I like fibs. I use fibs. I like round numbers. I use round numbers. I like ABCDs. I use ABCDs. Guess what? They are all not as important as to me. They are all not as important as structure. So a Fibonacci by itself for me means nothing. A round number by itself to me means nothing. An AB equals CD by itself to me means nothing. They're all secondary. The first thing I need to see on every chart are levels, zones of structure. Because if we have a Fibonacci by itself, is there any proof that price is likely to respect or react at that Fibonacci level? No. I don't have any proof of that. Now we get into a different story when we have a series of fibs. When we hear us talk about advanced patterns, that's a different story. That's a very specific series of Fibonacci's in a very specific order that produce a very specific outcome. That's a little bit different. But a single fib by itself, a single AB equals CD pattern, is always secondary to me. Now, those things are good for complementing levels of structure. So when we have a key level of structure, which is a key price in the market that is proven to be respected, and then it also comes at a Fibonacci level. It also comes at a round number. It also comes with an AB equals CD pattern. Now we're gaining more clues. We're like a private eye, a detective, a lawyer, right? We're gathering more and more evidence to make our case. And that's a very powerful thing. But for me, and it's very important for me because you can trade any way you want. I'm not here to stop you from that. For me, the evidence that we have from just the Fibonacci or just an AB equals CD is not enough to make my case in court. So if we have no other level of structure, we just violated our most recent level of structure, and we're looking at Fibonacci's, looking at round numbers, looking at AB equals CDs being all secondary, what else can I use to predict where price is likely to go to? Why did price stop right here? There's nothing on the chart. Why did price stop right here? You want to know why? VS1 on. It stopped here because of a previous level of structure. And this is our most recent one. It just happens to be 6 years ago. Sometimes when price is going to we break a level of structure and we may be testing an all-time high from 2014. It doesn't matter when it occurred. What we're looking for is the most recent level of relevant structure. Does that make sense, guys? And right now, this is the most recent level of relevant structure because after Brexit, we've been down for about 6 years. And we took out these highs. And now this is the most recent level of high. Let me know if that makes sense. Yep, so it doesn't matter when the structure is from. What matters is the most recent relevant level of structure. Now, again, if you're doing something like this, if you're like, hey, look at this level of structure in here. Now, this is a mistake. Why? Because does this level of structure right here, this one single inside level, have any relevance? Like, no, it's been violated a million times in the past. It's not the most recent, right? You'll learn in the foundation course about outside returns and inside returns, right? The most recent outside return is the most important one. It's a very good question, very good question. So we're at this key decision point. We identify we're at this key decision point, right? So we can go through that if-then process of if price holds, we're likely to continue lower. We've already had a hold. We've already pushed lower. So for me, that move has already been made. So I'm not interested in any lows. So the next thing I want to do, and I want to get way ahead of it, because it can be a very big opportunity, is I want to say, well, what's going to happen if we push higher? So let's play this out. We always want to visualize kind of what we're doing beforehand. That way we're prepared for it. We're not caught off guard. We're not shocked. If price were to violate this level of structure, right, our most recent new structure high, this would do what to our trend? Would this confirm our trend? Would this confirm our bullish trend if we broke and closed to the upside? You guys should all know the answer. I just went over it 10 minutes ago. Yeah, this would confirm our trend, right? So if we have a confirmed bullish trend, we would expect a continuation higher. So our next job as traders is to predict, well, if we're going to continue higher, where are we likely to continue higher to? And that's when we want to use, we can use fibs, AB equals CDs, all that stuff, right? But we want to also use previous levels of structure. So I ask myself, and again, apologize for zooming out so much, but I ask myself, well, where is my next relevant level of structure? And my next relevant level of structure is going to be right up here. How do I know? Two reasons I can identify structure. I don't have my VS1 set far enough back, but if I did, right, these lines are kind of where I have the cutoff at. You'll print some more. But if we just read the ebbs and flows of a price chart, big violation here. Oh, here's our pullback. What do we have here? Our most recent level of outside structure, correct? Would you guys agree? We also have a structure swap. Oh, look, another one. Previous support, smashed and violated, retested as resistance. What else do we have? We have something else here. Secondary. This is building our case. Even handled number. 175, right? And then we can actually add some fibs and stuff in as well if we want. Let's take a Fibonacci from, again, we haven't talked about this yet, but Fibonacci is other tools we can use. We can actually take a Fibonacci and an AB equals CD. So I'll take a Fibonacci extension from my swing low right here to my swing high, a little spiky up there, and back down. I'll also take, someone mentioned AB equals CD pattern. So basically a one-to-one measured move. So the length of this move, that same swing low to swing high, and then copy and paste it, plug it on to the retracement right here. It looks like a 3D2 retracement, by the way. Not that it matters, I'm just curious. Shoot, still got it. And we'll see if there's any confluence there as well. Still got it, Orsi. Still got it. All right, so we have a 1618 Fibonacci retracement right below that level. We've got an AB equals CD right below that level. So what we can do is we can start looking at a zone. We can say, okay, our structure is right here, a little bit below 175s. We have our Fibonacci ABCD confluence. this is the next zone that we predict price to go to. So identify is identifying what's happening in the market. We then want to use our tools of analysis to predict what price is likely to do next. And then we want to ask ourselves the question, this one's pretty obvious, but as traders, as we get more into the trading aspect of it, we want to ask ourselves the question, is there enough room for me to profit on this move? And seeing how it's moved from 164 to 174, I think yes, but everyone's different. And then eventually we need to get into how we'd like to trade it. And that's going to be different depending on who you are. You may be a breakout trader where as soon as price breaks through, you buy it right away. You may be a pullback trader where you need price to break it. You wait for a pullback and then you trade it up on a continuation move. We may see this if I ever get to any other pairs today. We have a bunch of ascending triangles in the market. Maybe you're someone that waits for this to form into an ascending triangle and you position yourself prior to the breakout. Those are not the irrelevant parts, but those are the least important parts for where you're at in your journey right now. The how you trade is all going to be dictated by your trading strategy and trading plan. What I want to focus on today and get the point across is the process of finding good trading opportunities using the ability to read a price chart. So let me know if that makes sense, if this opportunity makes sense. Again, it's not an opportunity right now. We're predictive in our analysis, reactive in our execution. We need a violation. This doesn't trigger until we violate these highs. That's the most important thing. And by violate, break and close. But we want to get ahead of it. We want to rehearse this. You want to sit at your chart saying, okay, if we violate 166, 164, 66, then I look for pullback back into blah, 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 blah. If I get pulled back in the blah, 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 then RSI needs to go oversold. If RSI goes oversold, then look for pin bar higher, high, higher close. If I get pin bar higher, high, higher close, then I enter next bar market. Stops go 1 ATR below the low of the pin bar. Targets go at the Fibonacci extension level that comes to the AB equals CD pattern. And then you just rehearse it. And that way, if the trading opportunity comes, you don't get the jitters. I can tell you what, analysis is easy because there's nothing at stake. When that trade signal comes, ooh, you get the wigglies in your chest. Hand starts gyrating a little bit, right? You start getting a little. You're supposed to push that button, but it's like a force field every time you try to push that buy button. It's like an invisible force field just stopping you, like a string attached to your finger. Someone keeps yanking it up, man. It's tough. It is tough, man. It is not execution, right? It's funny. We always the process IPDE: identify, predict, decide, execute. It's execute seems like the easiest part because it's like identify, that's analysis. Predict, that's analysis. Decide, that's strategy development and all that fun stuff. Execute, pull the trigger, right? That's the easiest part until it comes down to pulling the trigger, right? It's like life, right? Everything, it's easy when you say it, and then when it comes time to actually do it, then it's tough. It's like you're talking trash about someone, like, yeah, man, if he looks at me one more time, you know what I'm going to do to him? And then the guy hears you, and they're like, well, what are you going to do to me? And it's like, I'm not going to do anything. I'm not. It's one of those type deals in the market. So that's trading for you. We're going to look at a handful of other examples, but I think this was a good starting point to kick things off. Any questions about this process? We'll probably hit one more if I can make it quick before we take our break. I like to take a break every 45 minutes to an hour. It may be a little bit better to take a break earlier and then come back. But any questions about this opportunity here? We're going to look at a few more. Do you go to the 1 hour time frame? Yeah. So I personally go daily is my higher time frame. That's where I do my analyzing and my predicting. And then I go down to the 4 hour and the 1 hour for my trades. Yep. So again, today I'm trying to slow things down and not talk about too much of the specifics of trading, because what we learned in the past is that we don't want you guys to get information overload. So you come in day one, and it's 2 points we can focus on. It's the process and the analysis, and then there's the execution. And if you get flooded with too much at once, you tend to retain less. And especially traders tend to value, it's actually backwards. Traders tend to value, well, let me ask you guys this question. So whenever you learn something, what's one of the most common questions you think you have, or we get whenever you're learning something? Is it like, how do I enter? Is that a common question you either think or hear a lot? How do I enter? How do I enter? Well, how do I enter, right? That's typically the part that's most valued by traders. Like, okay, what's the entry? What's the entry? How do I get involved? And what's funny is that in trading, the entry is the most insignificant part of trading. You guys understand that? Should I buy gold? It's retest and structure. The entry is the most insignificant part of trading. Because guess what? There are millions of ways to enter. Jason Graystone's got a million ways he can enter. I have a million ways I can enter, all depending on the situation. But guess what? Is there any value in the entry if your prediction is off? Like if I have a good entry, we talked about this the other day on, a lot of new traders, they get caught up on the entry, and I'm like, well, okay, I got this entry for a buy, Akil. And I'm like, well, do you think price is actually going to go up? And they're like, I don't know. They gave me the entry signal, right? The prediction is the most important part. You can have the greatest entry in the world, but if your prediction is off, is that entry going to make money for you? No, you're just going to enter a trade that ends up losing. So the shift, what you see is that when you focus on the process, when you focus on the prediction, that is by far the most important part. The entry is easy. You choose a way, right? Predetermined, obviously, in your trading plan, but you choose a way. It's like, hey, I'm going to enter off of double bottoms, or I'm going to enter off of this, right? So we really like to focus on the analysis and instead of flooding you. And we'll look at another opportunity real quick, because here's another one that's similar. And I'll give you an example. So dollar yen on the daily, right? Now here's a cool thing. I'm going to already cheat it for you a little bit. But so dollar yen on the daily, we look at this. And we see something amazing. Look at that. What do we have right here? Let's ask ourselves this question about the trend real quick. Bullish, bearish. What's our trend, guys? Let's shortcut up here. Bullish trend, right? Yeah, look at that. Bottom left to top right. You got it. Now, recently, what have we just done? Literally yesterday, we have put in a what? Break above, close, a backer. Forgot all about that, Fitzy. Yeah, a backer. Break above, close above. A new high. So based on our rules, right, of just like analyzing price chart, we have a higher high, higher close, a brand new high. What would our prediction be next? No, I hit the mic button at top. I had to cough a little bit, so I hit the mute button. I usually do it on my mic, so you hear something like this. But I hit the one on the screen instead. So we would expect a continuation higher. Why did you choose the wick as the level? Ooh, good question. So who can answer that? Good question. Why did I choose the wick? George said, Akil would never. Oh no, I'd leave you for a better community in seconds. Oh yeah. In fact, I've got my assistant actively looking for a better community to coach right now. Yeah. Hey, I can be bought easily. Just gonna put it out there. I can be easily bought. All about the money for me, right? All about the money, guys. Mm-hmm. We've been talking about mercenary trading, right? Mercenary trading, right? Highest bidder, man. Highest bidder. I'm a trader. I don't have emotions. Just kidding. Unless the check's big enough. So why do we choose this level as our reference point? And Orsi mentions because this is the highest point that price has made. I forgot who asked the question. And Fitzy says the same, the highest point that markets get to. So this is the extreme, right? So remember our discussion on, again, hopefully you watched yesterday's training. Remember our discussion on candlesticks. The upper part of the wick, right? Give me a yes if you remember this. This is the extreme of price, correct? The highest point that price made in the session. The ceiling, the force field at the top. So in order to have a violation of structure, price needs to create a higher high, higher level structure to the upside. Price needs to create a higher high and a higher close, right? So this is why this level was chosen, right? If we would have chose just the highest close, and you can see we get a violation right here, this doesn't mean anything because price is still within that force field, that boundary. So we need a violation of the extremes of that level. I forgot who asked the question, but let me know if that makes sense. That was a good question. And a good response by you guys. Let me know if that makes sense. I think it was Raj. So we always want to take the extremes. Again, closes are important. Wicks are important too. I don't like to get into the discussion of which is more important. They both serve their purpose as we spoke about. Close is extremely important because it tells a very valuable part of the story, right? It's like a sports team. If you can play a great game and be up by 3 goals, and if you blow it all at the end, that's all that matters, the score. If you lost, you still lost. Who cares if you're up 3 goals? Now, if you look deeper into the game or the match, it does say something. Maybe you were up 3 and then you got 2 red cards for like deliberate handballs or something like that. So it does tell you a story about it. But at the end of the day, the box score is the box score. How about Everton fighting off relegation? Oh, yeah. Sorry, Man U fans. Just trying to keep our head above water. Just trying to stay in the big table. Ooh. Just to get off track for a little bit, right? Oh, I'm going there because I'm excited. This is what I hate about American sports because we don't have relegation. I understand why from a financial standpoint, but so Everton sucks. But I'm watching every game because there is so much at stake. There is so much at stake right now. In American sports, right? When you're bad, you just you try to be worse so you can get to a better draft pick. For here, there's consequence. There is a consequence of being bad, which again, not from a financial standpoint, it's horrible. But from a competitive standpoint, man, I love it. It makes it interesting. So I was at this, I was watching the match while I was on the road. So I'm on this bus watching the match and I have it on my headphones. And Anthony Gordon got that goal and everyone is silent. And I'm that one guy that's like, yeah! And clapping and everything. Everyone looks at me. I'm like, sorry. It was one of those moments. Everyone was silent in their own zone, and I'm just yelling. And no one knows what I'm yelling at because it's on mute or on my headphones. And I'm just I'm going nuts. Sir, can you sit down? Sorry. Oh, gosh. Still a long way to go. But anyway, yeah. Sorry, man. So the highest price that price is made to. So we have a higher high, higher close. I'm glad you guys are accepting these random distractions that they are going to happen. Higher high, higher close right here, right? Ooh, we got the hammers. Tony too. Higher high, higher close. So initially we would predict a move higher. Would you guys agree? Very similar to what we're looking at with pound yen, but this one's kind of happening already. This is what we were looking at with pound yen, right? We need that violation, then we can say, okay, time to get higher. If you're an aggressive trader, maybe you bought already on the breakout candle. Maybe you're waiting for a pullback. We got an Orsi inside bar right here. Maybe that means a little sideways shuffle and consolidation. A high and tight flag, which is one of the most profitable patterns in the market. But we got our entry reason. But what do we forget to do? What do we forget to do? An inside bar is a candlestick that completes completely in the range of the previous candlestick. Basically, it means consolidation. If you think about what the market looks like in a lower time frame, if this is the range of the first candle and then the second one is kind of inside it, it just means a tight consolidation. And consolidation leads to expansion, so you would expect some type of breakout. Left, up or down, we don't know. That's the analysis part. But an inside bar is one that completes completely inside the range of the previous bar. AKA the mother bar. So you can see one right here. We'll call these pregnant pauses sometimes. See this little red guy? Or gal, either one, or whatever it wants to identify as. You see this little red thing, this candle? Should have just stuck with that. This is completely inside the previous candle, so it's a little bit of pause, consolidation, then we break out. So what we didn't do is we never did our overall analysis. We never did our overall analysis. Are we at a point? Remember, the thing that we did with the pound yen was we asked ourselves the question, is there room for profit? Where is our prediction to go higher? We didn't do any of that stuff. And if we zoom out, and I'll bring these bad boys back on because they kind of cheated and gave it away. But if we zoom out here on the chart, you're going to see, what do we have? Oh, wait a minute. There's a big red box here. Whatever can that big red box mean? Maybe a level of structure looking left. Right at a key level of structure. Do we want to buy at the ceiling? Do we want to buy at a price point? Yeah. No. Yes, you guys are correct. No, we don't want to buy at the ceiling. Sorry. For you guys watching the recording, I'm not saying yes, we want to buy at the ceiling. I was excited because you guys typed in no, right? No, we don't want to buy at the ceiling. Yes, you are correct, right? So all of a sudden, we have all these things. We have our entry, our higher high, higher close, right? But is this a good trading opportunity? No. And we don't know that unless we do our analysis. So that's why we need to do our analysis first. We do our analysis. When I looked at this morning, because this is in my trading portfolio, I looked at this bad boy. I have my VS1s up, obviously, but I'll take them down for now. And I said, wait a minute. We're at a level of structure. We've got another level of structure right here. I'm not interested in buying here because there's no room to go. There's no room to go higher. So I don't even get to the point, honestly. I don't even get to the point where I really look at this because I don't care. I already know the answer. Oh, higher high, higher close, but it doesn't matter. This higher high, higher close doesn't matter because we're still within a range of structure. I don't go down to the 4 hour and look for reasons for entry. Why? Because I'm not interested in any buys. Now I can make my prediction and say, okay, well, if we break out of this level, right? Here's our inside bar kind of broken down again into that high and tight flag forming. If we break out to this level, now we can start looking for the next opportunity, right? We can start making those predictions of the future. But as far as like, oh, we broke and closed above, I got to buy. Not so fast, my friend. This is why we do our analysis first. This is why we have an order. 8:30 CPI coming out. This is why we do our analysis first. This is why we follow process, identify, predict. That's all analysis. Then once we have a confirmation bias, meaning once we have an idea of what direction we want to be in, then we start thinking about how can we get involved, and then you got to cut that rope so you can actually pull the trigger. Does that make sense, guys? Process stops you from getting in dumb trades. Most traders fail because they get into dumb trades. Well, most traders fail because they're not properly educated, and because they're not properly educated, then they get into dumb trades. But you guys get it. So we're gonna take a break soon. I'm right on an hour. I feel proud of myself because we always go over. I'm gonna tap myself in the back. Real quick, Kamani has a question. What is my personal trading portfolio? Make it easy for you. So you see this top area right here that says, oh, look at that. It says my portfolio. I thought it said primary. My portfolio, these are the pairs that are in my personal portfolio, meaning that I personally trade. Now, we look at all different pairs in the live room. We'll look at indices. We'll look at commodities. We'll look at some crypto every once in a while when they're actually doing stuff that's relevant. But these pairs up here, before we get to secondary, these are the ones that are in my portfolio. Now, here's what's important to understand. Just because they're in my portfolio, does that make them super pairs? Does that make them, quote unquote, the best pairs to trade? Of course they do, right? Because I'm a great trader and I only trade great pairs. No, they don't, right? It means that these are the pairs that I have chosen to trade based on the work that I've done in the market. And when I say work that I've done in the market, it means strategy development, it means back testing, it means portfolio creation. It doesn't necessarily mean that these are the optimal pairs. Not even based off my trading style. There are some other ones that I can't trade that are actually really, really, really good. But that's a different story when we get more into the business aspect of it, about creating your trading portfolio that supplements each other. Because again, good traders are great risk managers. It's not about making as much money as you can. It's about keeping a smooth equity curve. And for you guys that played around with the money management spreadsheet, I'm not sure if you guys got that, right? Did they get that? Maybe not. I think they did, right? I don't know. I get so confused. I think they no. Okay, not yet. You'll see where you can play around with like equity curves and position sizing strategies, and you can see some really cool stuff, some really like impressive returns. But those impressive returns mean nothing if you can't control your drawdown, right? If Andrew makes 100% return a year, that's amazing. If he takes a 50% drawdown on his way to that 100% return, I'd much rather have a 60% return with a 20% drawdown than a 100% return with a 50% drawdown. And that may not make sense to a lot of you guys because many of you are thinking 100% is more than 60, Akil. Why would that ever be better? You'll learn. Over the next 2 weeks, you'll learn. You'll learn what's really important. It's not the BS you hear on the internet. It's not how trading really works. It's not how professional traders think. It's not how professional traders operate. It's not how businesses work. Would you allow your business to take a 50% hit in a year? You'll go out of business. Then you're done. What do you have? Nothing. So there are more important things. Trust me. So we're going to take a 13-minute break. Grab your coffee, grab your water, grab your tea with the honey, and we'll come back. Again, if you have any trading opportunities that you want to look at, don't feel shy about printing them in. I have a lot more. We're going to see if I can get. I did 2, so I'm halfway. I bet I would get 4 out of my 8. But we can go whatever path you guys want to go, and I've got some cool examples. But we'll be here all week. So yeah, take 13 minutes. I'll put a clock up, and I'll see you guys in a little bit. Ha ha, Man U fans. Ha ha. All right, gang. Break time is done. Welcome back to the second half of the New York Live Trading Room session. Hope you guys enjoyed the first half. I thought it was a blast. Got to talk about some analysis. Got to practically apply some of the information that you guys learned yesterday. And of course, you guys had a lot of questions, which is really good. Now, was there any place in particular you guys want to start for round 2? If so, type it in if you had something you had on your radar or a question that you had. If not, we're probably going to go over to the Aussie yen or New Zealand Canada, as they have some of my favorite setups up on it. Actually, the Aussie yen, I called them the triplets. Aussie yen, New Zealand yen, Canada yen are all very similar. They all tend to kind of move the same way. So all 3 of them have this setup on it, but I think it's another important one for a breakout. New Zealand, Canada has it as well a little bit earlier. Real quick, Jason. Hey, Jason. Jason says, does the RSI play a role in your prediction process? Very good question. So, and the RSI can be used in many different ways. Don't get me started on kind of the zones way of using the RSI. But the RSI doesn't play a role for me in my trading rules in the predictive process, more so in the execution process. So I don't use any indicators to help predict which way price action is going to go. I use, again, I'm mainly, I am a price action trader, so I use the ability to read a price chart to do that. The RSI does play a role in my entry. So in certain scenarios, the RSI needs to be overbought or oversold in order for me to take a trade. Or in certain instances, the RSI needs to show bullish or bearish diversions or hidden diversions, for that matter of fact, to help complement a trade. Are you familiar with the CTS system at all, Jason? I feel like you are. Yep, or RSI swap. And again, we can get into zones. Maybe I'll touch on that in a little bit. But the CTS system was a system that I learned early on in my trading. It was actually, one of the first trading styles I traded. I was really bad at it at first because I was undisciplined and many other reasons. But what I loved about it was that it gave me a way to quantify my trading. I actually did a few videos on this on YouTube over the last couple of weeks and put out a podcast yesterday on it. But it gave me the ability to quantify my trading. So what it did was it took all the different tools that we talked about earlier, where it's structure, higher time frame confirmation, even handled numbers, AB equals CDs, fibs, RSI, and it assigns it a point value. And how you quantify your trades and really determine, hey, is this a great trade, a good trade, or a no trade, is by the point score that you have when you add everything together. So the RSI was 1 point if we were overbought. It was another point if we had diversion. So it played a role in really determining what trades I can take or didn't take. So it does play a role in that. Again, as far as the straight prediction process, I mean, like, do I look at the RSI to determine if we're going to be bullish or bearish? I do not. All indicators for me are secondary, so they confirm things. They don't kind of project things. And the reason for that is because so indicators are lagging. And when we say lagging, that's not a negative. It's just reality. I mean, price is lagging as well because, a candlestick doesn't move until orders have been executed. Now, there was someone out there on the internet that told me that they had all these indicators that weren't lagging. And then I asked if you can, I said, hey, I have a growth mindset. I'm not stubborn to think that I know anything. Like, please go on. And he said, well, I can't tell you because it's a super secret strategy. I'm like, oh, okay, that makes sense. But because they're lagging, they complement. Now, I'm not going to get into different ways to use the RSI because that'll take us down a whole another path. But yeah, good question. Let's head over to let's go to Canada again. So tempted to do the RSI zones thing, guys. You guys know where I'm going. So tempted. Let's go over to Canada yen next, and let's look at a different price pattern, which is interesting. So actually, let's see if we can go. I'm trying to figure out which one's the smoothest looking one. Canada yen, New Zealand yen. All right, so we can look at this, right? So Canada yen, and we'll start on the daily. Similar situation to what we've seen on pound yen and dollar yen. The yen pairs have been moving kind of similarly. We're going to ignore this as being a tradable opportunity because, again, you can see the VS1 level and the level of structure right above it. But following up on the discussion we had about candlesticks and reading a price chart, one of my favorite patterns to trade is going to be the ascending and descending triangles, because I think they really greatly explain price and its movement, and they're very easy to predict if you could understand the story. So as a quick recap of what we learned the other day, right? We learned about candlesticks and we learned about what the wicks and the bodies mean, right? So we know that the extreme low of this candle was where? What on this candlestick that I drew in represents the extreme low? Phil says potential Gartley as well. So the extreme low is represented by the wick, right? Would you guys agree? And again, just give me a yes. Just want to make sure you're clocking with me. I always try to read the room and see if people are lost or they get it. That way I can adjust my trading style, right? The wick, right? So what does this wick mean? Well, this wick means, right, we know the open is right here, right? This is the open. This wick means that at some point, price pushed down here. Would you guys agree? At some point, the sellers were in control because price moved lower than the initial opening price. So the sellers had momentum, right? The ball was in their half of the field. We also know that price closed up here. So at some point in this candle, could be a minute in, could be 23 hours in. At some point, these sellers were defeated and price closed up here, right? Does that make sense? Give me a yes. I'm going to keep asking you for yeses. Just keep that finger near the Y button. So this tells us a very interesting story about the market, right? We can just look at this as a single candlestick and we say, oh, it's a green candle with a wick, blah, 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 blah. But if you really want to dig in deeper into price action, understand the story that's telling you, you look at the actual scenario and you say that, hey, The sellers, the bears, tried to push this down. They had a little bit of success, but then they were blatantly defeated, right? They got smacked in the face and price went the other way. So we can read these stories from these candlesticks individually. We can also read them from the patterns that they put in. So let's keep this idea of buying and selling pressure, right? And this constant battle, this constant imbalance of buying and selling pressure, right? Because if there were ever a balance, a pure balance, what would happen to the markets? They wouldn't move, right? It would just be agreed upon, right? It would just be like, okay, oh, yeah, oh, 99.16, oh, that's cool. Yeah, okay, we'll just keep it there, right? So there's always this imbalance. And what's important to understand is that, and I'm going to try and say this in a way that doesn't confuse you as much, that, you know, sellers aren't always people that want to get short. Buyers aren't always people that want to get long. I'll give you an example right here. So let's say, Jason, we're going to mess with you, right? Jason, you're a buyer down here, right? We broke the VS1 level. We had a nice little pullback with this little bar right here. Lower time frame, that was a nice pullback. You got involved in a trade, right? You bought right here for some reason, right? Now, at some point, you're going to want to take profit, right? Would I agree? I mean, you could be holding on to a trade forever, but probably at some point you're going to want to take profit. You may not take all of your profit, but you may take some profit, right? So Jason is a buyer. Jason Stopper, I should say. Yeah, profit trade. Jason says profit would be nice. No, you hold forever, right? The trend is your friend. You hold forever. You never go, right? So at some point you want to take profit. Now, and you guys may not be familiar with orders and stuff like that, but if you are a buyer and you want to take profit, what do you need to do? You need to sell. All right, so let's say Jason Greystone, let's say half of you in here were also buyers, right? Jason Stopper's got this signal service. He sent the signal out, you blindly followed it. We all got involved in the buy at the same time. You know how it goes, easy money, right? So we all bought. Jason sends out the other signal. Hey, we're at a profit level, time to get out, right? So we're all selling. So we have this massive amount of selling pressure coming from previous buyers who are just exiting trades. You still with me, guys? Many of you never thought about it this way. So they're not actually sellers. We're not sellers because we're not interested in shorts. We're just selling because we need to sell to actually put money in our pocket. So you've got sellers coming from that area. And then, of course, you probably have another breed of traders who is like, Orsi's like, oh, we got previous structure looking left, inside bar. I want to sell as well because I'm actually interested in selling, right? Price has become high enough that it's a good selling opportunity. So then you have other sellers here that are actual sellers because they're interested in shorts. So you start to see an imbalance because you have previous buyers who are becoming sellers. You have less buyers. How do we know? Because price is getting more expensive, and as price gets more expensive, you're going to have less people interested, right? Just think about your grocery store. You're okay buying a gallon of milk for a certain amount of money, but once it gets to a certain point, you're like, hey, or like gas. You're like, oh, I think I'm going to ride the bike to work today because gas prices are a little bit too high. Eventually, price gets to a point where you're not as interested in it, right? And then the demand starts outweighing the supply, or the supply starts outweighing demand, excuse me. So you have less interested buyers. You have previous buyers that are sellers. You have new sellers that are sellers. The shift has happened from buying pressure to selling pressure. The selling pressure is outweighing the buying pressure, and that's what pushes the market down. Does that make sense? That's the game that's consistently played. Again, measuring out a trend, right? And then eventually it gets cheap enough where new buyers are like, you know what? I wasn't interested in buying it up here, but it's now cheap enough down here, so I'm interested in buying. And again, maybe those sellers that sold up here, They're like, you know what? Let's take a little money. I'm going to buy to take profit off my sell. And then like it just continues and continues and continues. And that's how the markets move. So understanding that perspective, and I don't think it's necessary, but I do think it allows you to see things differently, which gives you I don't want to say a massive edge. I think it does give you an edge. My trading changed once I started understanding whys and interpreting it, just instead of just being like, oh, pullback. So I can't say it's the same for everyone. In my experience, since we started teaching it, a lot of people really love it. But give it a try. It makes you look at things from a different perspective. It also makes you a better shopper as well. Start stalking cheese prices at the grocery store. Real quick, people step out the trade by volume, low sellers step in. Really helps me understand things. Good. So we have a pattern like this setting up. And we can look at these ebb and flows, right? So we have price moving up, lots of buyers interested, right? And then lots of sellers pushing it down. Now we have buyers interested, pushing it up. And we get to this point right here. And what we will notice here, if this continues, is you're going to see that each time the sellers push down, they're pushing down less and less. Would you guys agree? So buying pressure is coming in at a higher and higher level. So again, you look at the imbalances. Our highs are staying pretty. We have this little spike right here, which is news related, but our highs are staying pretty consistent. But our lows are getting higher. And in the past, many people would look at this pattern and you would interpret it as like, this is a big selling signal. Why is this a big selling signal? Well, because price action is testing a level of structure more times. But they're not necessarily looking at the opposite side of it. You're not necessarily looking at the opposite side of it. And what will happen here, if you notice, right, especially if we retest these highs and continue the same pattern, is that, well, let me ask you guys this question. If you are a seller, right, and you keep attempting to sell, and every time you attempt to sell, you're gaining less and less ground. So you attempt to sell and it retraces, but it doesn't retrace as far as you want. You attempt to sell again and now it retraces even further. You attempt to sell again, it even retraces even further, or it refuses to retrace even further, right? You're getting less and less result of each time you sell. Are you going to continue to sell, or are you going to give up and be like, I'll find another spot? You're probably going to retreat and find another spot. You're probably going to be like, you know what? I tried 3 times. I've got no reaction of the market. I'll just wait until price gets to 102, right? So all of a sudden you get your sellers who start to exit the market. They're not as interested even anymore. You've got stronger buyers because, again, each time the sellers tried to push down, the buyers blocked them at a higher and higher level, series of higher lows, right? Eventually, when those sellers retreat, all that's left is buying pressure. On the other hand, you have this, and again, if this is confusing, slow me down. If you are a seller, where are your stops? I hope I'm not confusing you guys. This is not the intention, but I get on these rants and they interest me, and I just keep going because I got to finish the thought. Stops are probably above the highs here, correct? Right, above previous structure. Could be 1 pip if you're a rookie trader. Could be 10 pips. Could be, somewhere around here, right? Again, now if you're a seller, what type of stop order do you have? And again, some of you guys may not know this yet, but you have what's called a buy stop. Again, when you want to get out of a position, you need to do the opposite. So like if you're a seller and you want to get targets, it's a buy limit. If you want to get stops, it's a buy stop, right? So now all of a sudden you have less sellers interested in selling. You've obviously got strong buyers down here. Now all of a sudden, as these strong buyers take control of the market and push up, push up, push up, not only are there less sellers interested because they've been defeated 3 times and they've given up, but the sellers that are left there that are still holding on to that hopium, now their stops are triggered. So now you have Not just less sellers everywhere, not just strong buyers pushing it up, but now you've got added buying pressure from the sellers who are stopped out because their stops are buy stops. And that's the momentum that the market uses to push higher and create that next extension. Does that make sense? Does that clear things up on how trends move? Not just what trends look like when they move, but actual the story behind them. Told you guys I was in the stories. Letters, words, sentences, paragraphs, chapters. That's the explanation behind them. Aside from like the insider smart money manipulation, but that's for another time. And manipulation isn't a negative thing. So that's how it works. So this specific pattern, again, if we continue, I would expect a bullish breakout. Now we have a VS1 level ahead of it. So again, there's not room for opportunity in my opinion until we break that level, but just focusing on this specific pattern, that makes sense. Now we had a few people mentioning pattern formations, right? Let's go down to a 60. We should see it clearly on a 60. A few things happening here. Let me see. There was a clearer one, I think. I want to get a clear one so we don't confuse people too much. Let's go to the I think the Aussie end's a little bit clearer. So it's the same setup. You'll see these pairs are all the same. But let's go to an Aussie end real quick. And will give us a clear setup of a potential advanced pattern formation, just because you guys have mentioned it. We don't need to look at this too much right now, but when we have these periods of consolidation, when the market is kind of going up and down and left and right, we often see something called advanced pattern formations or ratio patterns or harmonic patterns. And again, they come within those periods where the market looks like it's not doing much, but it actually is, right? And we have a few setting up here, right? If we look at a move like this is going to be our starting point. This is going to be called our X to A, our impulse leg or our anchor leg, depending on what you're looking at. This example would be an anchor leg. We have a retracement, which is going to be our A to B. Depending on what Fibonacci level this retracement comes to, that dictates what type of pattern we're looking at. Same thing with the B to C, which we just hit here. And then we would expect a D completion. In this case, this is a potential bearish Gartley at a completion point at the high right there. And again, you can see the market's consolidating. There's another potential one as well. We can look at the opposite direction, right? We can take a look at, I'll draw it in roughly for you, but this same type of move right here, where we're looking at a swing low to swing high, breakout from the low and tight. Opposite breakout, we'd expect the breakout to the other way. And that's our A to B. Our B to C is currently forming right now. Right here, I think is the highest. And then a CD completion. So this would be an example of a bearish Gartley where you would sell. This would be an example of a bullish Gartley where you would buy. So we're not going to get into too much about that this week because we're not teaching about fibs and all that stuff. So I don't want to, again, confuse you. But I know a few of you guys on the chat saw some of our traders talking about, a pattern hit already on the yen for target twos, a couple patterns forming here on Aussie yen and Canada yen. Just want to give you an idea, a visual of what they look like so you're not confused. Don't worry about them though. I wouldn't worry about, like, if you're new to this, again, what we mentioned earlier, focus on your focus. The main focus for you right now should be how to read a price chart, the interpreting of it. Yeah. No, you're fine, Phil. You can talk all you want. I'm giving a warning to the newer traders where it's like, hey, if you don't know this stuff, don't feel like overwhelmed. Where it's like everyone's talking about patterns and I have no idea what they're talking about. I'm stupid. I'm dumb. I don't belong here. Right? I invite both conversations, but just want to clarify for them. All right. Let's go to, we'll probably do one or two more pairs depending on how long I take. We got another pattern formation, a head and shoulders. That's a good one that we can talk about the story of price action. Aussie Canada head and shoulders. You guys want to talk about that? Sure. Let's go to Trading View because I've been on NinjaTrader all day today. What did I say? Aussie Canada? Aussie Canada head and shoulders. Yep. Right here. All right. So this is another classic price action pattern, which again, you can use the story of price action to help you predict how this is going to go. Now, again, this is not an opportunity that necessarily has a lot of room for trading potential, But this is a pattern that you will classically see in the market called a head and shoulders pattern. And this isn't the greatest example of your quote unquote traditional one, but here's the psychology behind the head and shoulders pattern. So price is in a directional move. Now, we know that, well, you don't know that, you're going to know it right now. When price is in trend, right? Well, let me ask you this question. If price is in a strong trend, will our extensions, so in this case our move up, will they be longer or shorter? So what would give us a stronger trend if our extensions are really long or if our extensions are really short? These are, by the way, these are different ways to kind of read strength of trend as well. If you're an Elliott wave person, you need to know that. I don't get into Elliott waves, but if you're an Elliott wave person, very important, right? So longer, right? Well, and right now we're not talking about the pullback necessarily. I'm just saying the length of the trend. So if I give you two examples of a trend, right? And I say, oops, not on Ninja anymore, sorry. If I give you one that is like this versus one that is like this, which is the stronger / healthier trend? The one on the left or the one on the right? The one on the left, right? Because the extensions are longer. Going back to the conversation we had about, buying and selling pressure, right? If the extensions are longer, we know that the buyers are very interested. If the extensions are shorter, we know that the buyers are either less interested or there's selling pressure on the opposite end. These bad boys here eventually become stuff like rising channels and wedges, right? So the one on the left is stronger, Tim, not the one on the right. The one on the left is the stronger / healthier trend. The one on the right is the weaker one. I'm not sure if you were saying right for the actual right or right in agreement. Let me know if that makes sense, Tim. If not, I can re-explain it. I have no problem repeating myself. I loves to talk. But let me know if that makes sense, Tim. Grab a swig of water real quick. All right, I don't know if we lost Tim, but hopefully that makes sense. So we know that in a stronger / healthier trend, we're going to see longer extensions. Excuse me. In a strong trend, should we be seeing longer or shorter pullbacks? Akil, I signed up for this webinar and I didn't know that you were going to put me to work. Should have read the fine print. we got to put that next time, Charles, in the emails. We got to put in the fine print at the bottom. Be prepared to work. Be prepared to put in effort. If you want to be a consistently profitable trader, you will have to put in effort. Shorter, right? Shorter retracements. Again, think about imbalances of buying pressure and selling pressure in this bullish trend example, right? If there's a lot of buying pressure, we should see lengthier, steeper moves. If there's not a lot of selling pressure, we should see shorter retracements. If we see longer retracements, that means more selling pressure, right? Because price was able to push down further. Right? Kind of common sense. Now that you think about it in this way, right? So this is what we want to see in the trend. Work? What? You mean I can't just sign up and poof, I become a consistently profitable trader? That's what that other company promised me. So going back to the head and shoulders pattern. So here's the psychology behind it. So the market has a directional move. We then put in a small retracement, right? So at this point, imagine we're coming off a trend. At this point, we're thinking strong trend, correct? Long extensions, short retracements. Are we thinking strong trend at this point? Yeah, right? Then we do this. We put in a extension, which still means we're in a bullish trend, but in comparison to this, This is a little bit shorter, right? Oh, I love this so much. I get so excited over this. You guys don't understand what it's like to end like, again, going back to like the magic show, like when you know how the tricks happen, like it just makes you so excited. When you're just not like a fan, when you're not a fan and just watching, you actually kind of understand, like it makes it so much exciting. I do that with sports as well because I played a lot of sports. So like when I see, around my friends, they'll watch like a football game, American football, real football, right? And they'll be like, "Oh, that happened," and I'm like, "No, you don't understand why that happened. Like it's amazing when you know what's happening inside." So, sign of a weaker trend, or a sign that, hey, we may see this trend start to end soon, right? Because the extension is less. Would you guys agree? So that's the first warning sign. We're still in a bullish trend, but we're like, starting to slow down. Again, if you're an Elliott wave person, right, this is your final wave before the AB equals CD. Same thing. That middle wave is the strongest one, right? So we get that. We're like, okay, we're still in a bullish trend, but let me keep my eye out on this one, like, because we didn't get as big of an extension. So okay, all right. And then we get something like this. This is another pullback, but what type of pullback is this? Is this a deep pullback or a shallow pullback? And again, we're not comparing the pullback to the previous one, but comparing it to the length of that it retraces in here. And if you want to quantify these things, this is where Fibonacci's are great, because you can bring a Fibonacci retracement up and you can quantify like 382 equals shallow pullback. 618 equals normal pullback. Under 618 equals deep pullback, or 786 equals deep pullback. So if you're someone that wants to quantify everything, you can actually quantify it with Fibonacci's. And so now it's like, well, Akil, what is a weak pullback? Okay, 382. Akil, what is a strong pullback? 786. Boom. Boom. Black or white. So this is a deeper pullback. So now you're like, okay, well, we had a smaller extension. Warning sign, spidey sense tingling. Now we got a deeper pullback. This thing may be coming to an end. And then the next clue, right? We're still bullish, right? Because what do we need? Pop quiz. What do we need to violate our bullish trend? I shouldn't use that word. What do we need to not be in a bullish trend anymore? Darn it. I'm always that teacher that gives away the answers. Yeah, lower low, lower close. That's what we're talking about. Someone's been paying attention. Yep, from our previous outside return. So we're still in a bullish trend. We're just getting some warning signs that, hey, now this is important because this will often stop us from doing what the undereducated traders do, right? Where typically the traders that get taken advantage. There's two types of traders in the market, right? It's feast or be feasted. That's how trading works, to be honest with you. Either you're going to feast or you're going to get feasted on, right? Either you're going to align yourself with quote unquote smart money insiders, or you're going to be a rookie trader that gets eaten by them. And typically the ones that get eaten, those are the ones that are always late to the party. Those are the ones where gold's been going up for like a couple months, and then like it gets on CNBC and they're like, gold is at highs. It's been on a rally for 3 months now. And everyone's like, oh, I got to buy it then. And then by the time you buy it, guess what happens? You know what happens. You know what happens. Yep. Lunchtime. It's too late. It's too late. So you want to avoid being that person that buys it when it's too late. My first really investing mentor taught me this. He said, by the time you hear about it on the news, the move's already been made. And that is so true. By the time you hear it on the news, you should probably be thinking the opposite. I remember this past Black Friday, I was up in Connecticut at this this awesome property right over this like private lake. It was amazing, and I got my Thanksgiving Day hangover where like I got turkey and gravy and macaroni and cheese and fish, like everything I can eat in my stomach. And I'm just like, I'm on the couch, just like, I'm not moving today. And I turn on the thing, and it's Black Friday, and it's like, new COVID variant, Super Delta, whatever it's called. And like markets are crashing. And I'm with a bunch of people, and they're like, oh my, they're checking their phones, checking their investments. Like, I got to sell everything. I got to sell everything. And I'm just sitting back with a full belly like, go ahead and sell. Where am I going to buy at? Where am I going to buy at, right? By the time you react to it, it's going to be too late. So we got this other warning sign. And then our next move in the Head and Shoulders is this. Price moves up to something like that. Now, we know that in order to confirm the continuation of a trend, what needs to happen? See, there was a point of me drawing out those two lines earlier. I'm just not doing stuff to do it, guys. This is all purposeful. I mean, it wasn't planned that I would get to this, but I made it seem like it was. I made it seem like everything earlier was leading up to this moment, and maybe it was. Maybe I shouldn't have said anything, and now you doubt me. We need a higher high, higher close. Now, what has this retracement started to do? We failed, not only have we failed to create a higher high, higher close, we failed to push up to the point of the previous extension, right? And then we come back down to do something like this. So this is our Head and Shoulders pattern. Now, there are different ways to trade it, depending on how you can be aggressive or conservative. But what do you think, and if you're a tier 1 trader and you know this stuff, don't answer. All right. Based off our rules of price, what do you think needs to happen to confirm this Head and Shoulders? For us to get confirmation like this thing's really going to play out. Based on what we know about price. Again, if you know the, yeah, I want to stop people from our premium members like to brag, where it's like, this is my chance to show off how good I am. And I actually tell them to do that. But this time I want to see, a violation of the lows. Because this violation of the lows violates our previous trend. We can now say like, hey, bull trend over. And that confirms our Head and Shoulders, which is looked at as a classic reversal pattern in the market. And again, it deals all with buying and selling pressure. It looks like a Head and Shoulders. If you can, I don't know if you guys, I do this every morning. Every morning I just stare at myself in the mirror for about 10 minutes because it's not every day you get to see something as amazing as me, unless you are me and you can stare at yourself for 10 minutes. I don't know if you guys go through the same thing. That's part of my normal routine. I just admire my beauty and be like, man, I'm so lucky. I'm so lucky to look this good. Then I have a meeting with Darren. I see Darren's beard in comparison to my beard, and I get self-conscious. And I grab like the razor, and I'm like, I'm never gonna be as good. But anyway, that's more of the personal side of things. You don't need to know about that. I love my beard. It's just subpar to Darren's. But anyway, it's depressing. Anyway, it looks like a Head and Shoulders. This is your left shoulder. This is your head up here. This is your right shoulder. A classic reversal pattern in the market. It's one thing to see it. And again, this is my philosophy on trading, right? It's cool to see this stuff and know this stuff. It is cool to see this stuff and know this stuff. But when you understand what it means, you can take things to a different level. And we're probably going to end with a cool story, right? So the trader I work with, I don't know if he's in here. Cody, is Cody in here? Yeah, Cody's in here, right? So I'm just going to humble brag on him. Cody's a funded trader. Here's another Head and Shoulders, right? This one doesn't give the example either, but Cody's a funded trader, right? Just cool brag, because Cody worked his behind off and he deserves every bit of it. And when I was teaching the Head and Shoulders, Cody actually taught me something, right? And it all has to do with reading a price chart. I'm going to go back to the first one actually. So in this scenario, right, we need a violation. This is our Head and Shoulders, right? Left shoulder, sorry. Get over here. Left shoulder, head, right shoulder. This is our Head and Shoulders. Now you can draw out the neckline either slanted or horizontal. That's your personal preference, right? And you look at a situation like this, and we need this level to be violated to confirm the Head and Shoulders. Would you guys agree? Yep. The problem is, right, in some of these situations, right, your profit projection may not be that far away. So entering a trade here, looking for a move down to here is not really worth it. And when he was studying Head and Shoulders, he came up with this cool idea, this cool observation, and this is how things are always happen. So he observed that, just how this Head and Shoulders, the neckline, the right neckline is a little bit higher. In some situations, that right neckline is going to break and close below structure before retracing back up. Now, again, just to be repetitive, is a break and close above structure a sign of potential reversal or a sign of bullish continuation? And this is why it's so important to understand price and all of that foundation junk I talked about before getting into strategy, because this is the stuff that allows you to create the strategy, right? More of a potential reversal. So he said, Akil, here's what I noticed. How about this, right? So if I have a Head and Shoulders pattern that violates a previous level of structure, then I can enter at the right shoulder instead of entering at the violation of the neckline. And what that does is it gives him a situation where previously, like maybe he gets a violation and a pullback and he can trade from like here to here, where it's like this very small range. All of a sudden, he's got a potential profit that looks like this. To something that either looks like this, a retest of that violation, or a move even lower. And even if we're taking a retest of that violation, which situation looks more profitable? Potentially profitable, obviously. It's always potential. The right shoulder buy, or sell, excuse me. But he's not just selling at every right shoulder. He's only selling at the right shoulder when he sees a situation where price has violated this level of structure, because he knows that a violation of this level of structure means something specific, which means this shoulder is more likely to hold than not. In a scenario like this, where we haven't violated structure, would I sell at this right shoulder? Hell no, because I have no reason to think that this is going to continue lower. There's no signal. If anything, right, we made higher lows. That's a negative signal. So this is why understanding how price works, how to read candlesticks, how to read levels of support and resistance, supply, demand is so important. Because the skills that you grow and build now, they're going to help you really design and redefine your strategy in the future. And if you don't know this stuff, you'll never be able to see the small clues that the market gives you. And I'm telling you, the market does a lot of stuff. And the majority of the stuff that it does is irrelevant. It's irrelevant. It's just there to trick you and get you confused and bait traders into trading all the time so you can take their money. What we're looking for as traders is a needle in a haystack. The key is we want to be doing it with a metal detector. We want to know exactly what we're looking for. We want to know exactly where we're looking for it at. And then we want to use that knowledge to develop a strategy that's going to put us in the most profitable, most potentially profitable trading positions, where the probability and the edge is in our favor. And you can't develop that if you don't know how to read a price chart. And again, we can even get into indicators, right? Indicators are great. You can make an indicator-based strategy, but understand that all indicators are based off of price action. So the better you can understand price action, the better you can actually adjust and interpret your indicator. Because here's another kind of eye-opener for you, right? Your default indicator probably won't work. If you just pick a moving average or whatever, a MACD, and you keep it on default settings, it's probably not going to work to your liking. You need to adjust your indicator to tell you what you want your indicator to tell you. And that means playing around with it. Some of you guys are noticing my RSI is a little bit different, right? How are we not overbought, Akil? We're at 71. My overbought is at 80. My oversold is at 20. My period is 7, not 14. I have it this way for a reason. I think the default is 14. But it's this way for a reason because it tells me what I want to see based on what price is doing. So it all comes down to price action. Learn it. Feast or get feasted on. So I think that's a good place to end today's session. Any last minute questions on either the head and shoulders or anything we talked about today? Can we say it's a fake out on a higher time frame of head and shoulders? In some cases, it depends on what it looks like on the head and shoulders. If you mean like a false breakout, there's specific rules for a false breakout. But some head and shoulders could be false breakouts on higher time frames. Some will not. One question was pound yen your top potential trade? No. I mean, it's not active. It's not active until we violate that level. So it's just analysis right now. So it's not a trading opportunity yet. So if we can violate that level, then it becomes one, and then it'll become very high on my list because I think it has a lot of potential profitability. But right now, it's not a trade. It's just advanced analysis preparing for a trade. So I know exactly what to look at every day with pound yen. I can come in and basically 1 second be like, okay, did the pound yen break that level? If yes, then I'm interested. If no, then next pair, wait till tomorrow. So I know exactly what I'm looking for on it. It just has to do it first. Can we use automated head and shoulders indicator if it's accurate? If your indicator, if it's accurately automated and it shows you what you want to see, that's the most important thing. It shows you what you want to see based on how you would see it, then yeah, use it. We've got a pattern recognition software like that, Enigma. You guys downloaded it yesterday. That is a very good pattern recognition software. There are some pattern recognition softwares out there that are completely horrible. So you want to make sure it's to your liking. That's the most important thing. Enigma shows me 99.9% of the time the things I would see with my bare eyes. I've seen some others where it's like, no way in hell. So you got to make sure it's good, right? There's a difference between something being automated and something being good. It can be automated and bad, and you don't want to do that. Anything else besides pound yen you're looking at? Just interested in looking at myself. Pound yen, dollar yen, pound Aussie, Aussie yen, dollar Canada, Aussie New Zealand, and New Zealand Canada were the 8 pairs on my radar today. But what's more important is you don't need to be looking at what I'm looking at necessarily. Be looking at based off what you require in your trading plan. Because some of the things that I'm looking at may be completely irrelevant to you. Just keep that in mind. But yeah, pound yen, pound Aussie, Aussie yen, dollar Canada, Aussie New Zealand Canada were all on my watch list for today. For discussion purposes here in the live room. Only ones in my portfolio are pound yen, dollar Canada, and Aussie Canada. First time I was taught this setup, they called it King's Crown. That's a good one. That's a good name for it. It does look like crown. That's a good one. I'm a student of kind of the classics, classic technical analysis. I like to think of myself as a classic chartist, or at least trying to become a classic chartist. You know, the journey's never over. So I know it as head and shoulder. But King's Crown, it looks like a crown as well. That's good. Maybe I should put a crown on when I admire myself in the mirror every morning now. It's a good idea. So first time I was taught this setup is called the King's Crown, but they never explained the why. So I was trading it everywhere, losing money. Then until I learned price action and get to know why, thanks to Tier 1. Thank you. Yeah. Again, I think, I maybe I should start being more confident in saying it, because I'm a believer that, everyone learns differently. You got to find your own niche for kind of how you get it. For me, though, when I started thinking of the market in stories and asking myself, well, why is price moving here? What is the psychology behind this? Because, price action is just a visual representation of all of the market's participants, right? So and we move markets based off psychology, greed and fear. So it is psychology. But it made me a lot more confident in what I was seeing. Like, it's one thing, like, I'm trying to give an example of trying to give it like a real world example. Like it's one thing to it's one thing to know that something works. It's another thing to know how and why it works. So it's like a car, for example. Like, I know nothing about cars. Like, I know when they make weird noises, I should probably get it checked out. Or I know when stuff doesn't work, but I don't know how to fix it. So it's one thing for me to get into a car and push the button or turn the key, and it starts and it goes. I know that. If I turn the key or push the button, it will go. But if something were ever to happen to that car, I've got to take it to a professional and be like, hey, look at this. I don't know why it's not working. And they're going to tell me why and charge me a lot of money to tell me why and fix it. Me having the ability to look under the hood myself and diagnose it and potentially fix it on my own is so much more powerful. Because I don't know how much you guys trust mechanics, but sometimes you take it in for one thing and they make it something else just so they can charge you more. I had to take mine in the other day and I was like, really? Why are you trying to sell me on this? I don't need an alignment as well. It has nothing to do with it. Just give me my tire. Just put my tire on. I don't need a new alignment. But yeah, I think it's powerful to kind of just to know how stuff works, and it gives you the ability to dissect it. And we haven't talked about this yet, but as traders, you always have to evolve, right? One of the biggest misconceptions out there is that everything is going to work the same forever. And I've learned, and I've been doing this 15 years now. I've learned that that's not the case, right? I shoot. If I were still trading the way I started trading, I'd be broke. So you have to adjust as market conditions change, especially in markets that are younger, right? Forex is still, it's not young in comparison like to crypto, but Forex acted a lot different when it first came out. We're starting to see a shift in crypto right now, where crypto was a very young, emotional market. Now it's acting more like a traditional market. The moves are getting a little bit less emotional and sporadic, as it kind of shakes out a lot of the, no offense, but like the dumb traders, the dumb get richy quickies. And you get more professional traders in it doing professional things and not doing as much dumb things. But the ability to understand why allows you to kind of dissect it and make the adjustments that are needed to really survive trading. And this is a game of survival. It's a game of survival where you can make a lot of money, don't get me wrong. But it is honestly, I still look at it each and every day where it's like, this is a battle. Like if I can get out of a trade at break even instead of losing money, like that's a win. I survived the day. It's a constant battle of, let's not go broke today. Let's do all I can do not to go broke today. And if you're doing it the right way, it typically results in profit. But that is the mindset. I'm sure Jason has the same thing, where it's like, hey, let's not go broke today. I'm sure Darren and Charles are like, hey, let's not go broke today. Let's find some good opportunities, but let's protect ourselves. Let's not do anything stupid. And that's how the game works, to be honest with you. I think that's it. The question, someone asked a question: for deep pullbacks, what is a safe range area for taking profit if you're following the trend? You mean like a trail stop, like exiting a trade because of a deep pullback? Like that? Like where do I bail? Yes, I wouldn't bail at all. If you're in a trend trade, why would you bail before the trend is violated? Fear. That's the obvious answer. But aside from fear, just like, if I'm betting on a trend, why would I bail until the reason that I'm in the trade is no longer relevant? I wouldn't. Because then what's going to happen is this thing's going to rally up and you're going to be pissed. Because you're going to miss all that money. So until the market, and this goes for any type of stop, my stop loss is at a place where the market tells me that I am wrong. That's where my stop loss always is. That's my philosophy on it. My stop loss is at a place where I am wrong. If there's one thing I hate being out of a trade when I'm right. So for me, if I'm in a trend continuation scenario, right, my stop loss, whether initially or trail, is below that level where the market tells me that I'm wrong. Now, you can Orsi mentioned your trade plan will determine that. You can back test, and you can look at a lot of data and say that, hey, every time we come back to the 618, the likelihood of us going below structure is blankety blank percent, and that will give you your edge. And it's like, hey, I'm going to put my stop loss at the 70% mark, because after 618, the probabilities are that this trend is going to be violated, and it's going to help me more than it's going to hurt me to get out of the trade here. So those numbers that we go through in the backtesting will tell you that. But as far as I'm concerned personally, I don't want my stop loss any place aside from the place that I know I'm wrong at. So, all right, we're going to get this, we're going to kick you guys out here. I'll get this recording up. I'll see you guys. Am I going to see you guys tomorrow? You guys got a training tomorrow. It's been a long weekend for me. I don't know. I'm going to see some of you tomorrow, perhaps. If I do, then I bid you farewell till then. If I don't, then I'll see you in the training and see you next time. All right, till next time, plan your trade your plan. Hope you learned something today. Enjoy the rest of Emergence 2022. See ya.